Good afternoon, everyone, and welcome to our February edition of Market Insights. I'm Matt Gordillo, partner and financial advisor, and I'm joined by Gavin Goecki, our portfolio manager, and Rich Lowry, our partner and chief investment officer. Welcome, gentlemen.
Good afternoon.
Before we begin, just a word from our sponsor. All right, very good. Thank you, Gavin. And I missed you last month. Todd was up last month, but so I'm curious to see what's going on since our last meeting. And as we start most editions, why don't you give an update from last month, and we'll go from there.
Sure. Yeah, it's good to see you, Matt. We really since the summer, we've been highlighting the idea that inflation is really done going down, I guess is what we've been saying, and it's kind of stalled out. And if we remember back to August and September, when the market was pricing rate cuts of 25 basis point increments into the end of 2025, we were seeing in August and September about 8, 9, and even 10 cuts priced into the market. Then the FOMC had their meeting in September and cut 50 basis points. But from there, we've seen all of that pricing come out to the point where we got a hot CPI and inflation data point today. And now for the end of 2025, the market is pricing only one 25 basis point rate cut. So I don't think full circle is really the right terminology, but just the idea that everyone now understands that inflation is not going down. It's not making it easy for the Federal Reserve to look at doing any rate cuts. So that kind of has been the backdrop for what we call quad 2 reflation or quad 3 inflation, battling it out, because inflation has been going back up and reaccelerating lately. And so where we are is really questioning what will happen with growth, which could be the other side of the equation to help figure out where we're actually going. So that's what's been happening, and just to catch us up from last time.
And we've been calling out this, inflection in inflation that's going to start to climb higher, I think going back to last fall. And prior to today, where we were able to see it is just the 3-month annualized rate of change was faster than the 6-month, which was faster than the year over year. So you could see some momentum building that hadn't sustained long enough to get the year over year to reaccelerate. Today, we saw the year over year accelerate. And, our view is still out of consensus in that a lot of people today are attributing it to a one-off. They're pointing to seasonal adjustments. But we have at least core PCE inflation, which is what the Fed tracks more closely than CPI. We have that picking up through the balance of the year. That's going to print at 3 or 3.1 when you get into the second half of the year. So, kind of the strongest case to be made is that, the disinflation is going to give way to, a new pickup of inflation. Nothing like we saw a couple of years ago. But the issue is it going to continue disinflating and landing gently right on top of the Fed's target? Or is it going to start to make a turn and head back up? And then the question is, if we have several months in a row where inflation is going against the Fed, then what? We would expect some kind of hawkish rhetoric to come out, some kind of, I don't think they're going to do anything on rates. Maybe you get some voters talking about, well, if this continues, we might have to do a rate hike. But more likely, you get hawkish rhetoric And maybe they do something on the balance sheet. So, we see the balance of this year being another year where there's headwind for bonds because inflation is sticky. And the sticky inflation theme has been, consistent part of these, these calls that we've had for the better part of last couple of years.
On that note, Rich, you talk about, stickiness and, we've got this new leadership now and there's taken over just a flurry of activity. And I guess for our clients, they'd like to know, how is this flurry of activity, how is it going to impact how we manage money between these? We talk about quad 2 and quad 3 and inflation being sticky or picking up and how it's going to affect economic growth. But, more importantly, we actively manage portfolios. So how do you take this activity that's going on and translate that into our actively managed strategies going forward?
Yeah, well, let's go through and review the 4 different regimes. If you plot the rate of change of economic growth on the y-axis, rate of change of inflation on the x-axis, you get 4 completely different economic environments. The more pronounced the rate of change, the more you would expect that to, impact asset performance. So when we talk about quad 2, we're in the upper right, which is characterized by economic growth accelerating and inflation accelerating together. Quad 3 would be the bottom right. Inflation is accelerating, but now growth is slowing. Quad 2 is risk on. You get paid to take risk. Quad 3 tends to be risk off. Probability of market going down is higher than it going up. And what's important about the regime segmentation is we're not trying to guess, we're not trying to forecast, we're not trying to time. We're trying to be in alignment with the prevailing dominant regime. So we track a handful of global stock markets, a handful of volatility measures, the major foreign currencies, major commodities, credit spreads, interest rates, etc. And the idea behind it is that those markets are going to have a tighter connection to what's going on in the real economy than the stock market. The stock market is driven by flows, and those flows originate when someone gets a paycheck, they put money in a 401k, chances are it goes in a target date fund where it's on some glide path, as if the market cares about how old anybody happens to be. So these other markets are more sensitive to inflections in growth and inflation. So by paying attention to them and being able to characterize the behavior across those other assets, we're able to conclude that the market today is behaving as if the economy is in quad 2. So that's kind of a what is the market doing exercise. Separate from that, we have a couple of different tools that do bean counting on the economic data to give us an idea that whatever quad we're in currently, what's the most probable regime change that we should look for. So when you add it all up, quad 2 has a lead on quad 3. The economic data that we bean count suggests that we should expect growth to slow. It suggests that we should expect inflation to continue reaccelerating, which means that the regime change that we want to be on the lookout for is going from our current quad 2 to quad 3. And that would be something where, as we reflect, depending on the strategy that we're talking about, the common thread across them would be, you would want to take risk down. And as it relates to the political part of it, the process is more quantitative and data driven, and there's no element whatsoever that factors, politics into it. Our view is that whatever the current president does is going to have an impact on growth, inflation, and liquidity, and we're already tracking that. will see that, just as the last president, whatever they did, is going to have an impact on growth, inflation, liquidity. And by tracking that, we want to be in alignment with, the current market regime. Now, we just so happen to the current administration is pursuing, 4 very large initiatives where each one might be unprecedented action. The initiatives behind tariffs alone, those might represent one of the biggest policy initiatives of, last few decades. And as it relates to tariffs specifically, we haven't had anything, come close. But to the extent those are actually implemented, we should see action in foreign currencies. We should see action in commodities. We should see action across these other assets to tell us, are markets concerned that tariffs are going to push us into quad 3? Basically, it's a tax on global trade. And if you tax something more, you're going to get less of it. So the expectation would be that we're going to have less international trade. Whether we can make that up with U.S., larger U.S. investment, we'll have to see, but there's a timing difference. It's going to take time to build things in the U.S. to replace things that we import. And because tariffs can be pursued with executive action, it doesn't have to go through the sausage factory of Congress to get passed. There's a more immediate impact. Same with immigration. So I don't know anybody that disagrees with deporting illegal aliens that have committed crimes. But latest readings on the U.S. labor force show there are 4 million people that are part of the U.S. labor force that are here illegally. So, there's a point at which immigration could start hurting labor supply. And the main characteristic post-COVID is that there's been more labor demand than there has been labor supply. Last administration tried to solve that by opening up immigration. It's possible that whatever the intended action is on immigration could have a negative impact, on the labor market. Kind of going back to the earlier statement, we see the range of probable outcomes widening, in that tariffs may never materialize, or we could be in an all-out trade war, where our tariffs are, they face retaliation, where other countries devalue their currency. There's a path that could go on where the outcome could be really negative, or there's a path where it could be positive. If it's just a sledgehammer to get other countries to do things that maybe they should have been doing all along, where the tariff never comes into play, that's a pretty wide range of outcomes. Same thing with immigration, same thing with spending. This time last year, we put out that report on the quarterly refunding announcement and said, we have now reached a point where the debt relative to the economy is big enough, and the deficit relative to the economy is big enough, that continued deficits are going to make it hard for the federal government to sell enough treasuries to finance deficit spending. There was one quarter where Treasury hit the market with normal Treasury supply and all risk assets sold off. That was July of 23. And since then, the former Treasury Secretary basically said, we're not going to do that anymore. Markets cannot absorb the amount of Treasury debt we have to sell. So they shifted the focus away from selling bonds to draining down a facility at the Federal Reserve and not getting into the weeds. The current Treasury Secretary was critical of that, but now he's doing the same thing. So as it relates to spending cuts, if there are enough of them that are credible enough where markets could look at this and say, hey, you know what, deficits are bad, but the peak is behind us. We're past the part of peak deficits. That could start generating demand for treasuries and make it easier to sell. So that could be a positive. And, rather than Gavin and I talking every morning, trying to say, well, what do you think this is going to be? Here's what I think. It's just, let's track the data. The data is apolitical. The data is not going to lie. And the great thing about markets is that there's no politics to it whatsoever. So to the extent anything happens, good or bad, it's going to be picked up in growth, inflation, liquidity. And our system is set up to track all of that and make whatever necessary adjustments there are to make.
Well, that's reassuring, Rich, because we have some clients are very optimistic with the change, and other clients are, extremely concerned with the change, as you can expect. And it just, what I'm hearing, it sounds like, we're not focusing on the executive order of the day, but we're going to be mindful of the data that drives our decisions for actively managing the portfolios and risk, trying to get our best risk-adjusted returns that we can for our clients. So I think that's reassuring. So I appreciate that.
Yeah, and I would just prepare clients that there's going to be more day-to-day volatility. We had the classic case. Was it Monday this week? Where we're going to do, or maybe it was last week. I don't know. We're going to do 25% tariffs on Canada and Mexico.
Last week, yeah.
S&P was down 2%. And by the close, they said, okay, we're going to delay the 25% tariffs, and the market rallied back. I would expect that to be a feature week in and week out.
Yeah.
And I wouldn't get caught up, in one direction or another on that. That's kind of letting price, drive things. But, as we look across our other, quantitative signals, we should be able to kind of distill the overall impact and, make the necessary adjustments.
Well, very good. We're all out of time. Gavin, thanks for the update from last month. And Rich, appreciate, as always, the education and outlook going forward. And we'll be back next month for our March market insights. Guides of March.
All right. Sounds good, Matt. Have a good one.
Thanks,
Okay.
Matt.
Bye-bye.